It's getting hot out there, but what about in real estate? How hot is real estate in the Las Vegas market as we start to enter the summer months of 2024? Well, let's find out. I am Justin Miller, the co-founder and principal at the ChongMillerGroup. At the ChongMillerGroup, we help people build wealth through real estate. We help people buy and sell homes here in the Las Vegas Valley. So this is the June 2024 market update for single-family resale residential properties here in Las Vegas. Remember, every month I pull the data on the 7th of the month. I record the videos on the 7th of the month, and then I get them edited and posted as soon thereafter as possible. Every month I post on or about the 8th of the month the single family resale market update for Las Vegas, and a week later on or about the 15th of every month I post the condos and townhomes or multifamily segment real estate market update, again for resale condos and townhomes in the valley. So let's go ahead and dive right in now to the June market update for single family residential. Okay, first point of business is price. We like to always know how much are things worth and selling for. Well, this is interesting information. The price, the median sale price, right? Not listing price, but sold price for a single family resale here in the Las Vegas Valley in May of 2024 was $467,500. That's up $5,000 from the month before, from what we saw in April of 2024. And interestingly, so that's up 1.1%. Interestingly, we are now down only $12,500 from the peak price that we had seen 2 years ago in May of 2022. So we had come down about 15% off of that peak price by the end of and beginning of 2023, and we've been slowly working our way back up. We're off that peak by $12,500, and kind of interestingly, there's only been 3 months in Las Vegas real estate history where we've had higher prices on single-family resales than what we saw in May of 2024. Obviously, one of those was May of 2022, so there were 2 others on the sides of that month. So we are moving back up. Now I'm going to suggest we will hit the 480 again before the end of 2024. Exactly where we'll close, don't know, but I had been predicting we will see significant price improvements, or appreciation rather, this year in 2024. So over the past 12 months, prices have gone up from 440 to 467,500, or 6.25%. Interestingly, 9 of the past 12 months, prices have gone higher. What that means is we're in an environment, for various reasons, as we discuss going through the remainder of the video, that prices are going higher. Irrespective of what you may hear from some of the talking heads out there, some of the commentariat out there, or read in some of the papers, we're in a market that's seeing prices go higher, up 9 of the past 12 months. And we're not going to see a sea-state change in Las Vegas with regard to prices. We're just not, because the predicates for higher prices are in place and prices will continue to go higher. Now, kind of interestingly, June of last year, so kind of looking forward to what next month's numbers may be, June of 2023, we were flat on price relative to the increase we'd seen in May of 2023, right? Which means that if prices go up at all in June of 2023, we're going to end up with a bigger spread on an annual basis here. Now, interestingly as well, June of last year, because prices were flat, not down, not up, but flat, that means that was one of those 3 months, one of the 3 months of the 12, the prior 12, where we did not see prices going higher. We only saw prices going higher in 9 months. Prices went down very slightly for 2 of those months over the past year, and were perfectly flat for 1 of those months over the past year. So again, strong pricing. Now, every month I look at pricing in a separate, additional way, so we get some confirmation about what's going on, and so we get some information about what's going on with the internals of the marketplace. And so I look at price per foot. What did the selling price per foot do over the course of the prior month? So in May, $257 per foot. That was the median per foot price on sales. And remember, per foot is not the way to price a home, but it does tell us something about what's going on with regard to the market, because we see, do price per foot numbers increase more in line with or less than the median sale price. Now, there was an utterly bizarre Realtor.com article that came out just a couple days ago, mentioning that because price per foot was going up more quickly, that was an indicator of lower priced properties coming onto the market and increased affordability. I don't know where they've been drinking, but they were completely wrong, utter bullshit. If you see price per foot going up more quickly than median price, it means properties priced above the median are selling a bit more quickly than properties priced below the median. So we actually saw 257, that's up 0.8% from 255 the month before. So slightly below the 1.1% increase at the median. That might suggest a little bit of slowing at the top end of the market vis-a-vis the lower end of the market, but it's a 1 month aberration from what we've seen over the prior 3 months. So there's no trend in place that says the top of the market is slow and the bottom of the market is more affordable. That's just not correct at all in terms of the reading and understanding of that information. It does mean that in May's numbers, we saw a little less activity at the top end of the market, but that's all that means. And it actually doesn't say anything at all about the lower end of the market. It doesn't say anything about what's going on below the median sale price, where median sale price, again, was up to $467,500. Prices aren't going down and affordability is not increasing. We'll talk more about affordability in a video in a month or two. But right now, know that affordability, unfortunately, is not improving. Things are tough out there for buyers, no question about it. Now, on an annual basis, and you can see this more in terms of what that trend was I was telling you, on an annual basis, we are up from $236 per foot to $257 per foot. We're up $21 a foot, or 8.9%. That means that, as I just alluded to, over this past year, we've actually started to see the upper end of the market improving vis-a-vis the lower end of the market. This was really significant because through 2023, we actually saw the upper end of the market slowing down. One may have expected that high interest rates would impact the lower end of the market, people who are more requiring of loans, than the upper end of the market, where maybe cash transactions are a little more prevalent. We didn't see that. We actually saw the inverse of that counterintuitively, suggesting that as interest rates have actually gone high, some of those higher net worth buyers have been deciding to sit on the sidelines and wait because they're able to get significant returns in the stock market or on other assets. And their opportunity costs, even though they may not be borrowing as much or paying as high an interest rate, their opportunity costs on their money became higher. And so it's nice that in 2024, we're seeing some reversion on that, where people who are in that upper half of the market are making financial commitments into real estate a little more readily. Not so much in the month of May, but certainly over the past 12 months, that's what we've been seeing. And almost all of that actually over the past 5 or 6 months. So that's actually really good news in terms of the health of the market. If we started to see price per foot numbers running away significantly above median, that's a really big problem for the market. Similarly, if we see price per foot numbers running away on the low end vis-a-vis the median sale price, big problem with the market. We're actually fairly tight in terms of the statistical readings here, up 0.8%, up 1.1% on the month over month. So there's no problems being exposed by these numbers. Rather, we're just simply seeing, hey, in May, the upper end of the market may have been a little bit slower than the lower end of the market. Anecdotally, I'm seeing that as well in terms of working with clients. Okay, so what about then the number of sold units? Let's go into our demand measures, because price is interesting. It's what everyone wants to know, right? When they ask how's the market. But it's only one statistic, and in and of itself, it doesn't mean a whole lot, because if we only had one sale, we still have a median sale price. That one sale could be really high, it could be really low in terms of price, but the market would be clearly incredibly unhealthy. So what's actually going on in terms of demand, and then we'll look at supply. So demand, we look at number of closed transactions or actual completed sales, and we also look at pending, which we'll look at just after closed sales. So number of closed sales, 2,131, single family resale in the Las Vegas Valley in May of 2024. That is up 1.0%. It is up 22 units from the 2,109 that we saw in April. So this is growth, but it's practically flat. It's really weak growth in transaction volume. The good thing, transactions did not come down, but the growth in transactions, very weak. Okay, so we've got real transactions that are taking place. There's a couple thousand of them, but it's a slow market. We are actually up exactly 1 unit of transaction volume from the 2130 that we had seen in May of 2023. So kind of interesting. The market in terms of transaction volume had gone down. 2023 was actually incredibly weak as a year. The rolling 12-month number for 2023 was the weakest we'd seen in a generation in Las Vegas. We've improved from the depths of the transaction volumes that we were seeing in late 2023, but we've only improved back to where we were last year on closed transactions. So interest rates are clearly having an impact here. There's just no question about it. And where are interest rates? Interest rates have been hovering at 7.0% plus or minus 0.1% for almost the entirety of 2024 to date. So we were a little above, a little below in March, a little above in April. In May, we've been right at that 7.0% line. So high interest rates, there's just no question about it. And the high interest rates are causing affordability challenges. Affordability is impacted by the purchase price. It's also impacted by the interest rate for the loan that you're carrying to support that purchase, because we know that 2/3 to 3/4 of all transactions are financed with mortgages in the marketplace. So expensive. So before we look at the pending contracts, the other measure of demand, let me look at one other sold statistic just because it's interesting. Not really. It's interesting only in the sense of disputing information, garbage information that's put out there by other people. And that is number of foreclosures. So number of closed sales on foreclosure properties, that spiked in May. It went all the way from 7 to 19. So in terms of percentage growth, that's really significant. Well, we're up 180% or thereabouts in terms of the number of foreclosures that have sold over the past month. But 19 in a population area of 2.3 million people. There's no foreclosure wave existing. And by the way, 19 happens to be the biggest number we've seen so far in 2024. Right? So if we took the average number of foreclosures that have happened so far in 2024, just over 11 a month, and we multiplied that by 12 months for the year, that'd be 132 foreclosure sales across the entire year. Again, out of 2.3 million people. Foreclosure wave hasn't hit. It's not coming. There's no ripple on the surface looking across to the horizon of a foreclosure wave coming. Here in the Las Vegas Valley, again, maybe if you go to some places in Florida or some places in Texas where they've got very challenging insurance and property tax environments, maybe there's something different happening. But here, it's a non-issue. And if you're waiting for it to occur, to be able to jump in and take advantage of some amazing deal, you're going to be waiting forever. You will not ever be a home purchaser here in the Las Vegas Valley. If you're scared to death it's going to happen and might happen to you, you need to be talking to better advisors as opposed to, like some of those commercials. Instead of looking under the blanket and worrying and looking up false information on what's going on the internet, maybe talk to a professional and find out what's actually going on and what you can do to protect yourself and improve your financial health. Because improving your financial health in this environment means being an owner as opposed to being a worrier. Okay, so that's the foreclosure side. So what about pending home sales? Pending home sales are another measure of demand because a pending sale means that something's in escrow. It means that a buyer and a seller have met. They've decided they want to transact on a particular property. A buyer has made an offer. A seller has accepted the offer through whatever negotiation needed to take place. A contract exists and escrow has opened. Once that escrow is opened, then we go through a whole series of steps. Usually takes about a month. Could be a little bit quicker, could be longer under some circumstances, but it's a whole long series of steps. Some of those involve subsequent negotiations, some of those involve significant activity and effort, some of them are simply paperwork drills. We go through that process, and at the end of the process, we have a closed sale. So that means that pending is an indication of demand, a strong indication of demand. Some pending contracts will collapse, and we'll talk about that with the back on market statistic, but you have to have a contract to have a close, and you have to have a contract also to have a back on market where a contract has collapsed. So pendings, 2,175. This number is up 3.1% from 2,109 that we saw pending in April. So that's good. This number is also above the sales number, the closed sales, 2,131. So that suggests some subsequent growth in the marketplace because pending contracts may become next month's closed, so they could show in June. The number is up 8.2% from the 2011 that we saw in May of 2023. So that's good as well. That suggests, as I was saying with regard to pricing, that we actually see the market dynamics improving from what we had seen last year, both in terms of price and now also in terms of demand. So that's good. But again, the market's really slow. This number is just above the typical November and December numbers if we look across history for Las Vegas Valley's home sales and home pending contracts. So very weak number, right? November is the second weakest number of every year historically. December is the weakest number of every year historically. That's where we're sitting, just slightly above what historically are the weakest numbers of every year. So that's what we're looking at for demand. Weak demand, but improving. And it's there, right? Real transactions are taking place. Again, a couple thousand transactions are taking place. So not bad news, just not a high level of transaction volume, right? Not super strong. Why? Because interest rates are really high. It's impacting affordability. It's impacting what buyers can do. The want to buyers, if you will, those buyers who are thinking, I'd like to buy a house. In some manner, they're not in this market right now. The I have to buyers, the need to buyers, I'm moving to Las Vegas for a new job and I need a house. Or I've just had twins, I need a bigger house, or whatever, the things that cause actual need, not just want. Those are the buyers who are in this market, they're participating, and they're buying at higher prices, even at these high interest rates. That's demand. That's what demand is looking like here in the market right now. So let's turn our attention to supply. What's going on in supply? Right, this is the inventory number, and we look at supply like with demand. We look at it in two different ways. One is number of houses already listed for sale, and the other is new entrants into the market, so newly listed resale homes here in the valley. So let's look at standing inventory first, number of homes for sale. And we want to know this because a healthy market has a supply balance with demand. We also want to know this because the lower the supply is, the less there is for buyers to look at, the harder it is for buyers to actually buy a house. There are just fewer things for them to be able to bid on. And what's out there may not match what they're actually wanting. So that means a balanced market actually has more supply than demand. And in fact, an actually balanced real estate market tends to have 6 months worth of supply relative to demand. So in other words, if we add up the sold units and we compare that to the number of available units, if we divide that, that tells us how long those available units would last in the market if everyone just simply transacted like everyone else. We know houses are actually differentiable, they're unique, so they don't all sell equally, but if they did, that would tell us how many months worth of supply. We like to see that number, ideally, something like 5 to 6 months worth of supply. That's what a healthy, balanced market looks like. Well, we're not there. We haven't been there for quite a long time. We're not there. Inventory has been going down. Inventory has continued to go down since it peaked in September of 2022. So we've got 3,903 houses, resale houses, standing inventory for sale here in Las Vegas Valley at the end of May of 2024. That's down. It's just down very slightly. It's down 5 houses from the number that we had at the end of April, 3,898. So down 0.1%. Insignificantly small, except that we're already at a really low level, and we're still in the spring season where we expect to see inventory building. And seasonally, every year, if we look at a pattern of inventory every year, inventory is going up at this time of year. We've not been going up. We're still decreasing, even though right now it's a tiny amount. We're still decreasing. We've been seeing decreases in inventory for 16 of the past 20 months. Inventory is going down, folks. Why is it going down? Well, one, because there's more demand out there than people realize. And so fearful suppliers, owners, say, well, I don't want to put my house on the market if there's nobody looking. Well, people are actually looking, people are actually buying. And so that's pulling houses out of inventory, and inventory is going down. Why else? Well, some sellers may reasonably think, if I sell, I'm going to have to buy a new house. And I'll have to buy a new house with a mortgage at a higher interest rate. Well, if the mortgage interest rate's higher, then I'm going to get a smaller house for more money. Right? Not unreasonable. It creates a psychological lock-in where there's a lot of people out there right now saying something that's really curious. Usually people say things like, I wish I didn't have a mortgage, but I love my house, or something similar. Now people are saying, I really wish I could move. I don't like my house any longer. It's not working for me, but I love my mortgage. I don't want to get rid of my mortgage. Well, that's really unfortunate, right? That's people in some manner putting the cart before the horse. They're making life decisions based on a financing issue. Why? Because interest rates are really high. What the Federal Reserve is doing to us is they are contorting the market by promoting these high interest rates. Yes, the Federal Reserve only controls the policy rate, the federal funds rate, but they influence all the rest of the interest rate markets, including mortgage-backed securities, by their statements, by the things they're doing with the policy rate, increasing, decreasing, holding it steady, as well as by engaging in quantitative easing and tightening, where the Fed goes into the market and buys other types of securities, other types of bonds, to influence demand characteristics on those bonds, where the Fed increases demand for interest-bearing products. They increase prices on those products, which actually means interest rates go lower. So if the Fed's engaging in buying of bonds, they push prices down. The Fed is now engaged in a process referred to as quantitative tightening. They have been for the past year, where they're actually selling off assets, bond assets that the Fed holds on its balance sheet. And as they sell those, they're increasing the supply of bonds, which is increasing that supply, driving bond prices down. Bond prices are inversely correlated with interest rates, actually 1-to-1. They're exact mirrors. So as prices on bonds go down, because there's only so much demand and there's an increased supply now, that's pushing mortgage interest rates, as well as potentially other interest rates, higher. Well, that's what the Federal Reserve is doing. And so they are literally contorting the mortgage bond market right now, which is influencing negatively, I'd suggest, the housing market, specifically negatively on the supply side, because we're seeing suppliers, owners of property, being even more sensitive to these interest rates than we are with buyers. So who's selling? Need to sellers. Right? Just like we saw on the demand side, it's those people who need to buy a place who are buying, as opposed to those who just simply would like to. Well, it's the people who need to sell. I'm relocating, I need to get out of Las Vegas, I need to get to another environment. Or I've had a death in the family, I can no longer afford this property. It's way too big, I need to get into something else. The people who need to sell, they're the ones who are selling. And it turns out, surprisingly, it's actually not surprising at all, in a growing environment like Las Vegas, where the population keeps growing, fewer people need to exit their houses than need to buy new houses. This is a demographic issue that happens in growing environments, and it's happening here, and it's going to continue to happen here. Supply is too low, and it's not improving. Demand, not too high, it's actually low, but it's higher than supply. We're looking at between 2 and 3 months worth of sales. The inventory is less than half of where it should be. And that's on the low sales numbers that we're actually seeing. Inventory at 3,900 is literally, it's about 32% of what normal inventory should be at this time of year in the Las Vegas market. Okay, so we do get new inventory into the market. Those are the newly listed resale units. A seller decides, a potential seller decides, you know what, I need to sell now. I'm going to go ahead and list my property. And so they come into the market with their newly listed house, resale house. We had 2,882 new listings come into the market in May of 2024. That's up. It's up 3.4% from the 2,787 that came in the month prior. So it's nice that's up, but it's up only to the point that we managed to hold inventory flat. We came down 5 houses on total inventory. So we're not seeing enough new listing come into the market. We're up 13.4% from the 2,541 that we saw in the unhealthy market of last year, when interest rates were actually going higher and was scaring a whole lot of suppliers as well as buyers out of the market. So we remain stunningly low on standing inventory and on newly listed inventory into this market. And we see demand outpacing the supply numbers, right? And that's pushing prices higher. That's simple economics. That's what happens. You don't have enough supply to meet the demand, prices go higher. It's been happening all year long. It's going to continue to happen. All right, one other statistic, And that's it for this video. And that is the back on market number. Remember, when something becomes a pending contract, a pending sales contract, goes into escrow, lots of activity starts, most pending contracts will close. We can expect that they're actually going to result in sales, except over the past 4 years now, we've been seeing real problems converting pending contracts into closed sales. We've been sitting at very high failure numbers. Well, we saw in May of 2024, 837 pending contracts failed and came back into the market. Some additional ones, very hard for me to track, but they failed and did not come back into the market. So these numbers that I'm giving you for back on market understate the failure problem a little bit. I can't quantify how large that additional impact is, but I can quantify for back on market, those that failed and came back into the resale market, 837, that's 28.2% of all contracts came back into the market. That's a stunningly high number, right? Again, for the past 4 years, we've been sitting way above the normal 10 to 12% back on market that we would expect in a healthy market or in the pre-pandemic market. Some people are starting to make comparisons to how the economy looks now relative to where it looked prior to the pandemic. Well, this number continues to remain hugely problematic. We've been running between 27 and 33% on back on market on all market segments for 4 years now. Massive problem. Find out why when you're talking to your real estate agent. Talk to me. I'd be happy to talk to you about this. Make sure your agent is helping you understand why this is happening and what you can do to resolve this issue so you can be protected, whether you're a buyer or a seller, because a back on market, a failed contract, is problematic for everybody involved in the contract. Okay, so that's it for the May 2024 real estate market update for single-family resale homes here in the Las Vegas Valley. I am Justin Miller with the ChongMillerGroup. At the ChongMillerGroup, we help people build wealth through real estate by understanding what's going on in the market and how to take advantage of the trends that exist by helping people buy and sell homes. Please feel free to comment. Please smash the like and the notification bell, and subscribe to the channel if you've not already. Share these videos with your friends, your neighbors, your families, your colleagues, anyone who you think may benefit from having real knowledge about what's going on in the real estate market. I look forward to seeing you in the next video. Thank you.